Welcome back to another top-notch video. This week, guys, we're going to be talking about the week of the 23rd of April 2018 through the 27th of April 2018. Had some issues last week, getting the video up. We are good to go, up and rolling for this week. First thing I want to mention is if you don't have a TSP account, we do go over the general indices and ETFs. So basically, no matter what you're doing in the stock market, this is a good video for you to watch. It's a weekly review on some of the major indices. So let's get right into it. The first thing I really want to talk about is the week in general, guys. We are still in this correction week, but I just want to go over some general charts to give you guys some ideas about what is going on in the markets to so that you can make informed decisions. So here's a great example of our Dow Jones, which is our symbol. If we scroll down here, VXF ETF or our S fund, okay, versus shorting the S&P 500, which the short for the S&P 500 is SH, and of course the S&P 500 is IVV or your C fund. Back in 2007 when we had our major peak, as you can see, shorting the S&P 500 was in favor of being in the Dow. Okay, and here is our 90 days after the peak for our 2018 correction. As you can see, we have a major difference. Instead of the charts going down, our charts are rising, and it'd be more favorable to be in the Dow at this point than shorting the S&P 500. So good things there. Let's continue on with a few other charts. Here's the S&P 500 C fund IVV versus your corporate bonds, which is a hybrid version of your AGG or your F fund. Okay, and what is in lieu of being favored here? So you have SPY or IVV, very very similar indexes, and you have the LQD, which is it's close to AGG, but not right on. But as you can see, in 2007, it was up until the peak. It was more favorable to own the S&P 500 versus bonds, and then that switched over as we reached our peak going into 2008, and then we had a decline for both. As we moved on. This is the 2018 correction 90 days after the peak. As you can see, it's much more favorable, and this is why we haven't recommended in the past couple weeks and months to be in bonds, just because it is more favorable at your time or at this time to be in the S&P 500 or the C fund versus bonds or the F fund or AGG. They are both still in the right direction, and the S&P 500 is still doing much better than bonds, and we've seen that as well. If we look at our charts later on, you'll see that bonds are in the negative for the year, whereas the S&P 500 is close to positive for the year. So bonds are not outperforming the equities at this point. So let's continue on. Here is the S&P 500 as of Friday's close, April 27th. This is our correction period from February here. And as you can see, we've been in this consolidation box for quite some time. This is one of the largest consolidations boxes I've seen in the last couple of years. Here was our low here at 25.32, and as of Friday's close, we are still 139 points above that low. Now, with this box, we were hoping for a kind of a W-looking effect, and we did not see that. We're still looking for a higher high here, but we're just consolidating off of those large gains from 2017. So just keep that in mind. Consolidation periods are usually followed by either a big move up or a big move down. And based off of the charts we just showed you with moving averages and what I'm going to show you, I think that we are looking at probabilities of being higher, of it going up, than higher versus being lower. But we don't forecast on this channel. So good chart here to kind of show you that we are still in a correction. If people say, oh, we're in a new correction, we've been in the same correction ever since February, guys. We have not seen a higher high here from our S&P 500 or IVV ETF or your C fund for your TSP. Okay, so moving forward, let's look at some other charts. So here's our moving averages. I wanted to just point this out real quick. Lots of moving average, the 100-day all the way out to the 290-day moving averages for the S&P 500, IVV, ETF, or the C fund. As you can see, in 1999 for the 2000 close, we had some real concerning things here after our 90 days out, basically 9 days after the high of 1999, 2007, and current day, 2018. Here's where we were looking at 90 days out. As you can see, very, very concerning with these moving averages all bunched up here and then starting to roll over. Back in 2007 with the crash there, we saw 90 days out this is stuff that you can see and put in a model before we had a major crash here of 2008. This is December time of 2007. And here we are in 2018. Here are our moving averages after the close on Friday. Still looking really good, guys. Still looking really, really good. Don't have a lot of concerns or issues with the C fund with the moving averages, but we'll also get into it in the charts. So continuing on, just some things that I want to show you guys, just some motivation for you as we're in this correction. It can be tough. Markets can be really hard, guys. When you're in a correction, you don't see your balances go up or down or move around a whole lot. But I just want to let you know that this is a great quote that we pulled from Mark Ritchie. In other words, in order to score really big gains, you have to be willing to see those gains erode significantly before getting out of the market. That's the question. And basically Mark answered with that is, I can't see it any other way. If you get too careful about not losing your gains, you're not going to be able to extract a large profit. Now, I just want to show you, one of the things I really like to emphasize on is history, because history can always teach you lessons. So what we're looking at here is the stock market S&P 500 C fund ETF IVV from 1996 or 1994 basically to 2000. So as you can see, guys, point A here and point B here, okay? Within that time period, we had a great bull market, but we had a number of times in here where we had some serious volatility. Volatility is expected and it is normal. 2018, we've seen a lot of volatility, and there are a lot of times where your balance would have decreased significantly in these time periods. But if all you have is just this time period here, it can look bad, but as you can see moving forward, there was significant gains. If you would have stayed in the market, the C fund or S&P 500 ETF IVV from point A to point B, you would have extracted 375% gain on your capital. That is incredible off of just about a 5-year period. That is incredible, guys. So the goal is to get from point A to point B. Yes, you're going to have times in the middle where you're going to see your gains erode, and if you're not uncomfortable about that, you should be a little uncomfortable. That's normal for the markets. On this channel, if we saw something like a foreseeable bear market ahead, we would say something about it. But I feel like this is, we've talked about this before too, that there's volatility to ignore and volatility to respect. And I feel like this is definitely volatility all to ignore in here, okay? And you would have extracted this gain, whereas volatility to respect is where you would hit 2000 or 2008, and we just haven't seen that in 2018. So keep your head up, keep your strategy going, and we'll move forward into our analysis now. So as all S&P 500, with the S&P 500, we did see seesaw of a week, like I said. Started here in the week and ended here in the week, so not a lot gained for the most part, just very stagnant. But let's look at it from a technical analysis. With our technical analysis, this is our weekly chart. We're still looking really good, guys. As you can see, this is a really positive energy coming out. A little bit of a spinning top here with price on a 2-day chart. We are moving down a little bit, but I'm not really concerned about that just because we have a strong weekly coming out. Next week, I would expect maybe kind of a week like this week, but we should start to see this, I would say maybe 2-3 more weeks, and we could start to see this maybe cross. We'll have to wait and see, but we'll go from there. Let's move into our S fund. With the S fund, that is ETF for your for the TSP folks. That's the S fund. For IRA guys, that is your ETF VXF, the Dow Jones. With the Dow Jones, we are right in the middle of our moving averages. We did have a little bit of a negative week. Was really hoping for that W to come out and have a real nice W effect out. Not seeing that with this drop here. Now we're looking more towards a head and shoulders look. So just keep that in mind. We could see that. We could see it bounce off this line here. Even if we do see it bounce off that line, that would be in the right direction. But just keep that in mind. But the charts don't show that, and I'll show you that on here with our technical analysis. We are coming out of a very long couple-week period with our charts. We hit negative territory energy back in February and have been in negative energy ever since, but we are coming out of that. We did see a little bit of a spinning top up here on a 2-day chart. We are seeing a little bit of a decline, but I'm not so concerned with that because we have a strong weekly chart. Moving on to international markets. So that is with our international markets, that's going to be TSP folks, that's going to be your I fund, or IRA folks, that's going to be your EFA fund, or EFA, I'm sorry, ETF, and that is international markets. With international markets, we did see a very positive thing the last 2 weeks. We did make a higher high here, so that is a very positive thing. We are above our 50-day moving average and our 20-day moving average. That looks good. I don't really like this line that they drew in here, so I'm more concerned about this line here. We need to break this top, but I am feeling much more confident since we came up above this high here. That should be good. And looking at it from a chart perspective for EFA or the I fund, on a weekly chart perspective, we are getting really close to crossing here, folks. I would say maybe next week or the week after we could possibly cross. Our DO is going from a 3.23 to a 1.49. We could see another good explosion of growth. Mind you, the last time we crossed this line here, the blue and the red, was back in January, and we saw this growth here. Quite a significant amount of growth for that fund, and we've been in the negative ever since February. Seeing some good positive price action here. I would, in the past, I had said not to get involved with the EFA or the I fund. I see this as favorable now. I wouldn't mind getting in. It's looking a lot more like our other indices, our major commodity indices. You know, with a 2-day chart coming down a little bit and a very strong weekly chart. So I don't have an issue with this. You have one more day to do an interfund transfer for your TSP folks or IRA folks. You have unlimited transfers, but if you did a transfer before noon on Monday, you could get money into this fund. This fund does look most favorable right now, but I'm not going to be moving a whole lot here. I'll show you that later on in the video. So let's move on to our last chart. Don't want to get distracted, but again, a recap of EFA or the I fund is starting to look really good again as we're moving forward out of April into May. So our last fund is bonds for TSP folks. That's going to be your F fund. For IRA folks, that's going to be AGG ETF, or your brokerage folks. With AGG, we have not ever suggested getting into this fund for 2018. It has significantly declined ever since September. In December, we did not see favorable things with it, and it has continued to drop. We did see some movement here, but we were not convinced based off the technical chart analysis. And sure enough, it just tanked the last 2 weeks. It had a really nasty last 2 weeks, and instead of being at that 107 line, we dropped all the way down to under 106 price-wise. Based off technical analysis with AGG bonds, F fund. For our weekly chart, we are seeing a weekly decline. This is a very negative thing, guys. I would not get involved in AGG at all. I would have my money not in AGG, in the F fund. The worst performing fund for 2018 so far. Just not a place to have your money. We had a little bit of a crossover here, so we were looking at positive things, and we're with this cross again, just not good, guys. On a 2-day chart, not good things. We are outside of our Bollinger Bands even. That's probably going to come back in, as you can see here. But with this negative energy here, it's just not a place to have your funds. And if you are in the life cycle funds, you do have money in AGG/CF fund. So just keep that in mind for you TSP folks. That is our technical analysis of our funds and major indices for this week. As always, if you guys have questions, go ahead and write them in the comments below. Please subscribe the video. Really appreciate your guys' feedback. I did turn off the music this week as per subscriber request. And let's move to our I'll show you allocation now. So we're leaving our money in the C fund and the S fund. That is IVV and VXF. We did a 50-50 split to have a little diversification. The S fund is doing a little bit better than the C fund, so just keep that in mind. And then for new allocations, we did make a change. So instead of putting new allocations into the C fund to get a little bit more diversification, we're going to move that to EFA, ETF, or the I fund. So new allocations as of this month. So May's allocation will go into the I fund, and that'll give us a little bit of a split, a little more diversification since the I fund just looks so good. And hopefully, guys, we see it's a positive month, green month for April, pending Monday, and hopefully a green month for May, and we'll have hopefully a better second quarter than a better first quarter. Again, please like, subscribe this video, or share this video, guys. I really do appreciate your support, and we'll see you guys next time. That's another top-notch video.